Welcome everyone, JoAnne Hamberg from the Real Estate Exchange, and I have Kim Stone here from Bay Equity Home Loans. And tonight we're talking about purchasing multifamilies and what's involved with the process and financing and all that. You know, um, so anyways, I'd like to introduce Kim. If you want to tell us a little bit about yourself, Kim, and your company, that would be awesome.
Sure. Um, First, I want to start by saying thank you for having me. It's always a pleasure and a privilege to work with you and the real estate community. So, thank you so much. And thank you for giving people the opportunity to learn all this information in our little talk here tonight. I've been in mortgage banking, specifically mortgages, for almost 25 years now. So, that's a really long time in mortgages. And I've worked for everything from banks and brokerages to credit unions and direct lenders. So I have a really well rounded background of all of the programs, the products, and the guidelines that might be available for somebody who's looking to get into investing or multifamily homes.
A lot of people do the first time home buyer programs, but not many people talk about the options with multifamilies. And, a first time home buyer or even a second buying up, owning a multifamily, you can get a 2, 3, or a 4 unit. There's lots of different financing options, and it can be very lucrative, especially for a first time home buyer to have the rents to help with the financing because of course they can use the additional income towards their purchase. They can also start earning passive income for the long term and have something to leave for their family to be able to have a legacy to leave behind. Benefit from additional tax write-offs, they build their credit. There's just so much to offer with multifamilies just to create a portfolio and own more than one. I've owned multiple properties throughout the years, multi singles, and even a mobile home park. A little bit of this and a little bit of that. But it's just a great alternative, and people just don't always think about it. And it's also great for these families that are um, joining together, and multiple family, multiple generational homes with like parents or siblings all living together. So I really appreciate you taking the time so that we can talk to people. And if anyone has any questions, you're welcome to leave them in the chat, and Kim and I will answer them at the end. So I guess how to start off is, how do you use the rental income to help someone qualify to be able to afford a little more home than they would normally?
That's a great question. And we get that question all the time in mortgages. I'm going to answer that. And you touched on some really good points as far as owning multifamilies and all of the things that they can do for you as far as building wealth and stability and being a stepping stone. And, there's a lot of individual or solo buyers out there, and they have a certain price range that they might be looking in. And when you look at a 1 to 4 unit, you do have that ability on several of the loan programs to have that rent help you qualify for that home because you can use that rental income to help you qualify. So, for example, if you were looking at a 2 unit home, 1 unit, if you're going to buy it as your primary residence, you would occupy, but that other unit is going to generate income. And there are many loan programs that allow you to use a portion of that rent as your qualifying income for that home. The go to program for many, many years and very popular in our community is FHA. That's been the one that's been out in front for most because it's really one of the easiest to get into as far as the qualifications, the credit scores, the ratios that you have to meet. And also, too, because you don't have to have any prior experience as a landlord in order to use that rental income to qualify, which is a big factor as well. And then nowadays, conforming or conventional lending, Fannie and Freddie, you might know them as, have also answered that call by also allowing rental income to be used to qualify. And the factor is the same. So we can use 75% of that gross rental income towards your qualifying income to help you qualify to buy that house. And that might increase that price range a little bit for you.
Yeah, absolutely. I bought my first two family when I was like 18, and the people I bought it from had to agree to rent back to me in order for me to qualify for the loan. So they agreed to stay for like 6 months just so that I could qualify for the loan. So it was very helpful. I was all by myself, and that was my first property. So it was really, was very helpful to have the rent to qualify just on one income. So,
Hmm.
and a lot of times, how do you know what's the best option for financing for a buyer? What would you suggest that they need to? I mean, I always tell everybody, go get pre-qualified, sit with a loan officer, and what are the things that you're looking for, and what would you suggest for someone to say, all right, you want to go FHA or we want to go conventional?
Also, another great question. And I think where there's so much information out there today on the internet, some of it's great information, some of it may not necessarily be the most current information. And the reason for that is, of course, because guidelines and programs, they do update, they do change all the time. The good news is, buyers don't necessarily have to try to figure out which is going to be the best program for them. When you work with, a strong loan officer or lender, part of their job is to make sure that we are putting them in the best program for them financially. It's called a fiduciary responsibility to the client. So when that application comes in, it's our job to review each aspect of that application and then look at the guidelines and the programs that might be available currently and try to make sure that they're getting into the best program available to them. And when we look at that, there's a couple factors that we're going to look at. We want to make sure that payment is right for them. We want to make sure the down payment is also within their budget. Those are two of the major factors. And then that they're qualifying for that program credit wise. So that the credit score is going to meet those programs. So, credit score is usually where we start. And then we trickle through the programs from there as far as what's going to be the best possible option for them, as far as a well rounded financial picture. And nowadays, we have a lot of programs. That are available for people who want to get into a multifamily home, which is 1 to 4 units. So, in the past, FHA, like I mentioned, was really the go to program. It's one of the oldest programs in the country. It actually was initiated after the Great Depression. Little known fact, to help boost the economy and bring America back to pre-depression days and home ownership. But nowadays, there are local or what are called community programs, Community Reinvestment Act programs, and that's where you have a program like Mass Housing. You also have these programs available in other states too, New Hampshire Housing, Rhode Island Housing. And these programs have answered the call for multifamilies, allowing borrowers to put as little as 5% down and towards qualifying for a multifamily home, which is very, very similar to FHA. And on some of those programs, the buyer contribution is only 3% of that sales price. So you have a very low down payment, and you're still able to get into that multifamily home. And a conventional loan option can provide some advantages to that home buyer, because the qualifications for that home, that property, are a little bit less constrictive than that FHA program when it comes to the property.
Property condition, yeah. The
Yeah.
nice thing too, especially where rates have gone up a little, that, maybe considering a two-family would help offset some of that expense.
Hmm.
So it's a great alternative for people to think about. What about, people buying two, three, four non-owner occupied? What do you have for programs for people that are looking to be investors that just want to buy their first one and get their foot in the door? And you know, um, what would you recommend for a program for an investor with little as
So
possible
investors all,
down?
I'm sorry, I didn't mean to go
As
ahead.
little as, no, no, as little as possible down, because we always like to keep what we can in our pocket, you know.
Right. So a true investor. So sometimes people think they're an investor when they really are a primary owner occupied property. So first to clarify, if you're going to buy anything from 2 to 4 units and you're going to live there, that becomes a primary. So even though it's an investment because you've got these other units that can generate income for you, it really is your primary residence if you're going to live there. And so a lot of the programs we've talked about so far are for that primary ownership. If you're a true investor and you want to break into investing where you're not going to occupy that property, then generally speaking, you're going to be looking at a 25% down payment program for a multifamily. So 2 to 4 units, you're generally going to see 25% down is the minimum requirement for that as far as a down payment goes. It's still a conventional program. That's the conventional guideline. There are some exceptions for lower down payments on a single family investment. So, something that we have seen more recently is people investing in a condo. If a condo comes on the market that's well priced, somebody may pick up a condo, which is a single family and still
Mhm.
an investment. So, you may be able to get away with 20 or even 15% down on those. But you do want to have that conversation because obviously with that lower down payment it might be reflected in the interest rate where you might pay a little bit higher interest rate to start, and then as you pay down that mortgage you can look at refinancing down the road as you build more equity in the house. But generally speaking, investment wise, you're going to be looking at 25% down for conventional. We do also, there are also programs that are hitting the market today. They're somewhat new to the market and kind of industry driven, and these are loans that are debt service loans or debt service ratio loans they're called, and that allows for the property itself. It's almost like a commercial loan for a residential property. So if you want to keep kind of your finances separate, you can look at a debt service ratio loan, and what that does is we actually cash flow the property itself. So the more money that property makes, then the more cash flow you have on that property when you weigh it out, and you can actually qualify for the property based on its cash flow alone.
Yeah, great
Um,
program. You know,
yeah.
one of the things that you mentioned that I think is awesome is, you know, every investor buys something different. You know, I first started with multis, didn't really care for them. So then I went to single families and I liked those. And of course, now we went to the mobile home park. But I have a friend who just does condos. He
Mhm.
loves condos because there's no real maintenance. You know, tenant moves in, so he has to repaint it after they leave or replace the carpets, but he doesn't have to worry about any outside maintenance. So everybody has a different niche on what they like to purchase. We have
Mhm.
another friend that all he buys is big multis, like 12, 14, 50 unit buildings. And that's a little more than I can handle. But everybody has a different tolerance level, you know. So and you just got to find out what your niche is and what you like, you know. And like I said, my
Mhm.
favorite is single families and individual units. So I know we talked a little bit, but we didn't get into too much detail about the different types of loans your company offers, like the mass housing. Can you tell a little bit more about like how the mass housing would help with a multifamily for an owner occupied?
Yeah, absolutely. Mass housing, they say you're not supposed to have a favorite, but I really like mass housing. So I've been lending with mass housing for a very, very long time. And it's really great to see the evolution of mass housing. They've made it very simple as far as what you need in order to qualify. And they've even opened up their products for somebody who's not a first time home buyer. So in the past, mass housing was a program that was designed specifically for low to moderate income earners that were first time home buyers. And with the needs today, they've expanded their program to include first-time home buyers, non-first-time home buyers, single families, all the way up to 4 units. And they've expanded their program to cover all the way up to those 4 units. So the mass housing program actually breaks down into 3 programs within mass housing, including a first-time home buyer program. You do have to be a first-timer for that one. They also have what's called an HFA Advantage or Preferred. And that is for the beauty of this program. In the past, you had to be a low or moderate income earner in your community in order to qualify for that
Mhm.
program. And they've actually opened that up so you can be making as much as 135% of the area's income and still get into these amazing mass housing programs. And then they have their last program, which is called the Workforce Advantage. And this is for that lower income earner in the area. All the programs are open to 1 to 4 units, all primary residents, and they all allow for some type of down payment assistance, which is amazing. So, with the down payment assistance program, you can actually get into, if you're eligible for that program, you can actually get into a multifamily program with a 3% borrower contribution. That means 3% of the client's own money, with a total down payment requirement of 5% down.
So
And
the
you
other
can,
2% can be through the program, or can
yeah,
it, or how would it be used, the other 2%? Where would that come from?
yep. So it can actually come from the program, and you can actually use. Here's the crazy part of it: you can also use the down payment assistance if you're eligible for the down payment assistance. You can even use some of that towards your closing costs as well. So it's really amazing. They actually lend up to 105% of the value of the home. So, right? So, little known, people say, well, they're never going to give you more money than the house is worth. Well, yep,
That sounds
mass
like they
housing
will.
is. So, mass housing will go to 105%. Pretty much all their programs that I just mentioned will go to 105%. So, as long as you're eligible for that down payment assistance to go with the mass housing program, then you may be eligible for that 105%.
The additional amount, can that only be used towards down payment, or could it be used towards like future repairs or anything that somebody wanted to fix on the property?
So that's a renovation feature or a rehab feature on the loan. And we do also have renovation loans. Generally speaking, if somebody goes into a renovation, they're going to go into more of an FHA product. There are also, there's a new choice program from Freddie Mac. Which is eligible for multifamily homes. But for mass housing, they do have a renovation loan, but that's actually only available through a very small handful of banks. And that's because of the servicing part of it. If you're doing a true renovation loan, the work's going to continue after you close. And so some of that money has to be set aside to be paid out as you do the work or at the end of the work. So in order for that to be managed, you have to have kind of that savings and loans footprint. So
Mhm.
mass housing does offer that type of a program, but it's typically only found through a local bank. So you don't see it as much. It is available in all my years, and I did work for many years for a credit union, and we didn't offer it there, even though it could have been available. So if you see a renovation and a multifamily, 90% of the time or more, you're going to see an FHA loan. FHA
That's,
also allows for that.
yeah. And, speaking of, well, so the mass housing, just so we're clear, you can't use it towards renovation, but you can use it towards closing costs, don't?
Yes. Yep.
On the FHA, so the couple things like the 203K loan for the FHA, which is the renovation loan, you buy a 3-family and it needs 3 new furnaces. How would that work? I mean, how do you get the extra money? So you're buying the multifamily for 400,000 and it's going to cost 100,000 to put these new furnaces in. How do you work that so that we can get the repairs done after closing?
That's a popular conversation in this market. The houses that are hitting the market in some cases, they're looking for a little TLC, and so they may need some type of work. So I'll try to make it kind of as straightforward as possible for the sake of time. Basically, if you have a house and you have that sales price, that the seller's going to get that whatever a price you agree on, but you as the buyer may need some money to help you with the renovations on that house, or to bring that house up to standards or up to code, or so that all the utilities are up to speed. And there might be other things too that need to be done, but we'll deal with furnaces in this case. So let's say you needed 100,000 for 3 furnaces. What we would do is basically we'd establish that sales price for the seller, so the seller knows they're getting that price for the house. And then we would get quotes or estimates on the 3 furnaces, the installation, basically the product and the work that needs to be done in order for that work to be done, or those utilities to be added. And we'd submit those quotes, and depending on how much it's going to cost and the extent of the work, would determine if we would go with something like a limited 203K or a full 203K. And once the price tag gets up there, it's going to be a full 203K. And once you add a structural feature, it's going to be a full 203K. Those are kind of the two triggers for the full, no matter what. And if need be, at times, we need to bring in a consultant to help with that. It's called a 203K consultant. But basically, we get the quotes in there. We get, a licensed, if it's furnaces, we're going to make sure we have, the licensed professional who's going to come in and get these installed. And we build all of that into a quote. And then we put a buffer in there, because we all know the price of things can change. The price of labor can change. The price of a sheet of plywood can change. So you build in a little bit of a buffer. It's called a reserve. And then the loan amount is going to get written on that. So then what happens is you have closing, and you're going to close on that loan, and the seller is going to get his chunk, called his net proceeds. And then the rest of that money that's been estimated and quoted and signed on the dotted line is going to get held into an account called an escrow account. And then that work is going to begin. And depending on the loan itself, would determine whether or not we're going to be able to cut some money up front, so that contractor or installer can get some supplies, or if it's all going to come at the end. And at the very end, you have an inspection, make sure that all the work was up to snuff, and that all of the codes and ordinances and licensing was in the right place at the right time. And then they sign off of it, and everybody gets paid, and you're in your house with your furnaces.
It's great to know that there are programs that will do renovation loans for multifamilies, because
Yeah.
it's a unique market. And furnaces on older properties, they go, but and
And
roofs or
boilers.
whatever. So it's nice to have that. Yeah. So my property, and buying a 3-family furnace is no good. My uncle is a heating and plumbing contractor. Can I have him do the work?
I'm so glad you brought that up. I should have mentioned that. JoAnne, you just know your stuff.
The two of us.
So a little interesting fact about all renovation loans. If you do dig into the guidelines, they are public. If you ever were to Google it and you wanted to read several thousand pages of the rules of lending called guidelines, grab the popcorn and go.
Yeah.
The guidelines will, the guidelines are in there saying, hey, family, friends, people that may be okay. But generally speaking, what happens is you're going to get the kibosh on that when it actually gets into underwriting. So you really can't have a relationship with, meaning aunt, uncle, brother, sister, cousin. They really can't be doing the work. It has to be somebody that it's a associated or non-interested party. And that is really done to protect kind of everyone involved, not just the homeowner. But family and friends are not able to do the work. A lot of times I get calls and people say, oh, well, same like you said, my uncle is a electrician or plumber or something like that. And as much as you want to use them, you really can't because there is a relationship there. So if you ever hear the term, it's an identity of interest, an IOI, that's what you have. You have somebody that's too close to the transaction.
Oh, that's great to know. Because I know like when I had done my 203K renovation loan, we had to get a couple different estimates, and I had to make sure that whichever contractor I selected, I need to make sure that was the contractor that did the work. I
Yep.
couldn't get somebody else after the fact that was going to give me a better deal. So just something to keep in mind when you do it. And it does take a little longer to do this
Mhm.
type of loan just because of getting all the estimates and getting all the paperwork together and having the inspector come out and review. So
Mhm.
again, if anyone has any questions, please type them in the chat, and we'll answer them for you. But one of the other things, Kim, that bring up is when you're like a first-time home buyer and you are buying a multifamily, one of the things that's come up with buyers, because we're always worried about how much money we're going to need, is reserves.
Yes.
Especially on an FHA loan, if you're buying a 3 or 4 family, a lot of times the lenders is looking for reserves. How does that work? And how much do they usually determine that you need?
Yeah, that's changed over the years too. I'm
Oh,
sure you've seen that. So in the past, reserves was a requirement. So, if somebody called me up and they wanted to apply for a mortgage or get pre-approved, a lot of times we'd actually start with the money they might have for a down payment plus closing costs plus reserves. Also, years ago, you didn't see sellers' concessions as frequently as you see them today. So we used to start with the assets and the reserves. And with the FHA, that's still a thing because the FHA, they kind of have a black and white guideline as far as 2 to 3 months generally minimum
mhm.
when you're looking to buy. And that can even be true for a single family for some files. With the FHA, it's really kind of the total profile that gets evaluated. And then, we put it through what's called an automated underwriting system, and it will tell us. But generally speaking, FHA, you're going to see a 2 to 3 month minimum, um, especially if you're going into a
Reserves.
multifamily. Yep, called reserves. But you could actually see it get triggered on a single family too. So getting into a single family doesn't always mean you're going to get away with not having reserves. So I think as far as what a reserve is basically the total housing payment times however many months of that you have to have set aside, and that's your reserves. So, for example, if your mortgage payment were to, including taxes and insurance and MI, if that mortgage payment added up to $2,000 and you needed, for example, 3 months of reserves, you would need an extra $6,000 in an account that you would have access to at some point in order to be able to get that loan in order to be qualified to use that loan to buy the house. And sometimes, people get a little nervous about that. They're like, "Oh, where am I going to get 6,000?" Additional accounts can help. So things like 401ks, IRAs, retirements, if you have a portfolio or stocks, bonds, mutual funds. Believe it or not, I'm actually doing a loan right now with Bitcoin. That's the
Oh,
hottest.
geez,
I know.
that's interesting. Yeah.
Just know there's a lot of paperwork if you're gonna use Bitcoin or any
Oh my goodness.
cryptocurrency.
Yeah.
Um, Now, Fannie and Freddie is a little bit different. Fannie and Freddie, it is profile specific. So a lot of these first-time homebuyer programs like Mass Housing, Freddie Mac also has a homebuyer program for multifamilies. It's called Home Possible. And more often than not, they're actually not triggering a reserve requirement for those. Fannie Mae still does trigger it, but Freddie Mac, a lot of times, especially if you're doing a Home Possible program, there's actually no reserves required um, on those
Great.
programs.
Kim,
Yeah.
you're a wealth of information, I will say. Um, and, I really appreciate you taking the time to help us. And I think that, it explains to people that, you don't only need to have money for down payment, you have your closing costs. And in some cases, you need to have reserves. So it's really important to meet with your loan officer, get
Mhm.
qualified, understand the program you're with, and then find a realtor that you're comfortable with, that's knowledgeable and can guide you through the process. There's a lot involved.
Mhm.
So I really appreciate you taking the time, and I appreciate everybody who joined us today. We didn't get any questions, so I guess we just did a good job and we answered everybody's questions as we went along. So again, thank you so much, Kim, and I really appreciate it. Everybody have a great
Oh, thank
evening.
you.
Keep an eye out for our next webinar next month. Thank you so much. Bye,
Thank
guys.
you.
Bye.
Bye.